Welcome to another episode of Kiss My Assets.
The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate.
It was initially the 12% return, but it quickly turned into the people.
Well, welcome to another episode of Kiss My Assets. I'm Jamison Manwaring, co-founder, CEO of Neighborhood Ventures, and I have Heather Andrews with us with Investor Relations. Hi, Heather.
Hi. Couldn't get rid of me if you tried.
No, and I wouldn't try, so we don't have a problem.
Good.
I want to jump in. We just did our quarterly live stream that we record here in the studio. We put out live with John and I. John's the real estate expert. I'm more of the finance guy, so we kind of get together. We do this every quarter, and we just came out with it last week. And we also do a live Q&A with all our investors. And a couple of the questions that came up I just wanted to highlight, because I think that's where a lot of people have, when they think of multifamily and the real estate market, they probably have some of the same questions. So one of the questions that came up was, do we take debt on our projects? Because as we know, interest rates are ratcheting up. As interest rates go up, the cost of debt also goes up. And the answer to that is yes, we definitely take debt on our projects. If you don't take debt, there's absolutely nothing wrong with it. It certainly decreases the risk because you don't have to make a payment every month. But the great thing about real estate is it's easy to get low interest debt on real estate. So if you don't take debt on it, let's say you're buying a $10 million building, you have to raise $10 million for that building. Where if you do take some debt, say 60%, you can go raise $4 million in equity, take debt of $6 million, and you can buy the building. So there's less you have to raise in equity if you take debt. So it's very standard to take debt on real estate investments. The big thing that we're doing right now, though, is we have low interest debt on many of our projects, especially once they get stabilized. They're generating cash flow. They're fully occupied, so they're generating cash flow. We can easily pay that mortgage payment. What we don't do is re-lever up after we've got a property renovated, and we don't recommend doing that, because even though you can, if you're going to buy a home today, there's some low down payment products out there where you can put 5-10% down and buy a house. And it's better to put 30 or 40% down when you're buying a house. But if you can only put 5 or 10% down, that's an option. But when you're managing an investment like an apartment building, it's better to keep the debt low. And that's something that we believe in. So we keep the debt.
And you have a range that you aim for, right? We kind of have a formula or...
Yeah, we like to keep it under 60% of the value of the building. And that's pretty conservative. You could go as high as 80 to 85%. We like to keep it lower.
We are conservative in financial.
Yeah,
which I appreciate.
We don't like that, pushing for more debt ends up putting more pressure on the property, and it's just not a great way to operate long term. Yeah. But we do use debt, and what happens is as interest rates go up as they are right now, the cost to buy a building goes up because you're going to put some debt on it, and so your monthly payments increased, and so that does have an impact when it comes to apartments and when it comes to multifamily, both when you sell and when you buy. When rates were very low earlier in the year, people were buying buildings for higher because they could get 3% debt. And that's a big, what we call input into our business and our cost analysis when we look at buying a building is in fact, the biggest input is what is your interest rate on the debt? You're going to have costs across the board when you buy a building. You're going to have maintenance costs. You're going to have property management costs. You're going to have all these costs. The biggest one by far is the debt. And so that was a question that came up. I think it was a good question. We wanted to clarify that. And it's also just something that's nice to learn. You know, if I buy a building and I can put 40 or 50% down on the building, you're just lowering your debt, you're lowering your risk significantly. And that feels a lot better than if you're putting 10% down or 20% down. So
it makes for a less anxious Heather, which everyone appreciates.
Yeah. And so for us, you know, we have 250 Heathers, investors on every project. And that's why part of why we do that is to keep the debt low. So that was one question I thought was good. Another question that came up was, when is the right time to sell a building? And we have like 8 projects right now that are 8 or 9, I think 9 projects that are currently in our portfolio in the process of either paying cash flow out to investors or renovation. To be specific, we have 4 that are paying cash flow to investors, and we have 5 that are in various levels of renovation and stabilization.
Yeah, this is one of the most common questions I get when investors call is when are you going to sell?
You want to know how long until I get my payback on this investment. I was talking to an investor this morning who's invested a lot in real estate notes.
Yep.
And they used to pay back in like 5 to 7 years, and now they're trying to pay back in 10 to 15 years. And for him, it's like, that's a long time to get my money back.
Yep.
So it's really important when you're looking at investment to make sure it lines up with how long you're comfortable not seeing that money. Some investments, like real estate, they are not liquid, meaning they are in a fixed asset that you don't get that money back until you sell that building or until the building gets refinanced and you get paid back. So it's important to know the timelines of those investments. Ours, on our single projects, are 2 to 3 years, and each project is different. And that is our target hold period. And we publish that and we communicate that with investors at the beginning, and then throughout the process, we want them to know where we're at in that process so that they can plan, because once you get your money back, now you actually have to redeploy it somewhere else.
Hopefully into the next project.
Could be into the next project, but you need to kind of know, sometimes you need to do something else with the money. Sometimes you want to redeploy it into some other type of investment. So it's important to know what the time frame is. And then there are some investments that are into perpetuity. They never have an end period.
Yep.
But there's a process called redemption, where if you want to get out after 3 years or 5 years, you say, hey, I want to get paid out. And there's a process around that. There's typically some penalties there when you get out, but it's those penalties go down the longer you stay in. So every investment's different, but the important thing is that you understand the time frame. Yep. And for us, if we tell investors we're going to hold a building for 3 years, we don't really want to sell it after 6 months, even if we can. And there's been situations where we can and do very well on it. But we know that our investors want to get that 12% return over a period of time. So I'll just give an example. If we had sold one of our buildings that this year has paid 12% return, but we decided to sell it in January, and our investors got all their proceeds in January, then they have to do something with those proceeds. Maybe they put it in the stock market. Maybe they put it in a mutual fund. If you put it in the stock market, it goes down 25% this year.
Yes.
Because the market is down 25% this year. But instead, they've been able to keep their funds in our investment because we didn't sell.
Yep.
And they've had a 12% increase this year on their investment. So that delta is like 37%.
Yes.
So not only are they getting the 12%, but they also didn't lose on the 25% if they had put it back in the market. And that's what most investors do. You don't necessarily want to keep your money in cash. You'll typically move it around to
You want it to
maybe
keep
the
working for
market.
you.
Yeah, you want it.
You're trying to keep
Although
building.
it would have been better if they
Yeah.
kept it in cash than the market. But that's why we try to keep our projects around the time that we aim. It's not always going to be possible. There's other considerations we have to look at, but we try to do that for our investors' sake so that they can plan. And then we publish that and we communicate it throughout the process so that they know when that's coming up. So I thought that was another important question. And the biggest thing that we try to do is buy low,
Mm-hmm.
sell high.
Yes.
And so
It sounds so simple.
yeah. And it it's a lot harder than it sounds, I think, sometimes. But we don't want to be in a position where we're forced to sell or we feel pressure to sell. We want to sell it when we think the project is at its best time to sell.
Mm-hmm.
That tends to be once it's stabilized, once it's generating cash flow, then we can sell it. Does have some to do with interest rates. If interest rates are lower, it tends to be a better time to sell. If interest rates are rising, sometimes buyers back off a little bit. And the best thing with real estate is throughout that time, you are cash flowing once the property's stabilized, and you're, as an investor, receiving monthly payments anyway, and the mortgage is getting paid, all the expenses are getting paid. You're not in a position where you're forced to sell. So I thought those were good questions, and I think it's important to look at them. I always talk about the analogy of the old analog clock, the one with the two hands.
Yes.
When you think of investing, you're trying to buy at the low point, which is a 6 on an analog clock, and you're trying to sell at the 12, which is the high point on an
Right.
analog
Before you
clock.
turn back into a pumpkin.
Yeah.
It's a Cinderella story.
Exactly.
Yeah, I know.
Yeah, exactly. It's impossible to buy at 6 and to sell at 12. But what we really try to do is to buy around 7 or 8 and sell around 10 or 11. If you try to wait for the very tip, you might turn into a pumpkin.
Yes.
Like to your point. And it's always really difficult to know when is a low point in the market as well. But you can start to see when there's some momentum in a direction.
Yep.
So if we start seeing that momentum, at the 7 or 7.5, great time to buy. And then we try to sell once it's near the top. So I love that clock analogy. And that's what we're trying to do when we hold on to our properties. So I want to jump into a couple important headlines that, as an investor, as a real estate investor, multifamily investor, is important to know. There's a few things here that have been in the news already, but it's been a couple weeks since our last podcast. Inflation is decreasing when it comes to the level of the rate, because inflation came in at 8.2 in September. The peak was 9.1 in June,
Yeah.
but it's still really higher than
Still
what
high.
we hoped and expected. That
But
came
I'll
out a
take
couple
that
weeks ago.
little bit. I'll take any little bit they want to bring it down.
We'll take it.
Yeah.
Yeah, that's right. We'll take it. But the Fed is still going to continue to increase rates until that comes down to the target range.
Yeah.
Target range is 2%. So
I don't love math, but that seems like a big.
we have a little ways to
Yeah.
go. So we are not expecting inflation to come down to 2 in the next couple of months. It's probably going to take some time. It generally takes 6 to 18 months
Yeah.
for an economy as large as ours to start having inflation. So we didn't see it for a while, even though the government was putting a lot of supply of money into the economy with PPP, with stimulus. So it took a little while for that to start impacting prices. And then now, as they're trying to slow it down, it also takes that 6 to 18 months. So we're expecting that to continue for a while, that the Fed will continue to raise rates, maybe not at the levels that they have, because they kind of have been playing catch up with 0.75 of a point increases for the last several meetings. But we do know inflation has to come under control. They're not going to stop raising rates until it comes down to that 2%.
And there, he's been really clear about that. Is it Powell, the Fed he has said we are staying the course. Buckle up. This is happening.
Right.
So,
And that's the right policy right now.
and I think
in
even
my
globally, a lot of maybe foreign ministers, a lot of globally they are agreeing. It's the same messaging of we're holding firm.
Yeah, the U.S. isn't the only one dealing with this. It's every developing economy, every developed economy, developing economy in the world is
they're on
dealing
the same
with
page
inflation.
on this.
Yeah. And COVID caused this because there was a big reaction from the government, and now we are having to pull back and let the system work itself out and let this money work itself out. So it's going to take some time. And going back to our prior dialogue around what's happening with inflation or with interest rates, if you want to know what happens with interest rates, you look at inflation. Because if inflation came back down to 2, the Fed could ease up on interest rates and interest rates could go down. But we're not in that position right now. But some good things to note that have happened since inflation has gone up. The government has increased Social Security benefits.
Yes.
And
across the board.
Across the board, 8.7% increase to kind of match where inflation is, about 9% over the year. And so that's something that people who are on a fixed income living on Social Security, because of inflation, there's already some built-in things in Social Security that if inflation increases, Social Security will go up. It's important that gets increased because the cost of living has gone up. And then the other thing that's kind of related is that tax brackets have also increased. Tax brackets have gone up by about 7%. So that means, this is just an example.
Yes,
that
you
means
have to explain what this means.
If you are paying 30%, if you're in a 30% tax bracket and you're making $100,000 a year, now, and if you're making under $100,000 a year, it's 25%, and once you hit $100,000, now it bumps to 30%, because that's how
they want a little
our
more
tax
piece of your pie. Yes.
Yeah. The more you make, the more percent you have to give in.
Yeah.
So they've increased the tax bracket so that instead of it being at 100,000, it's at 107,000 now in order to pay the higher rate. So that, because of inflation, also moves up the tax bracket, so you can make a little more and still be paying the same tax rate. So those are things that, sometimes government doesn't make sense. Those are two things related to government actions that just tend to make sense.
It does.
You think so too?
I think they could have. The article I read about this, it should have been that short and clear. As soon as I saw something about tax, I'm like, nope, I cannot. I need a nap.
Yeah,
and
it is that simple. Yeah. Some good things happening in Arizona. Arizona is in some ways a bellwether of the growing economies, the hot housing market. So a lot of people look at Arizona and they're kind of constantly monitoring what's happening here. Obviously, we're here. We're always looking at Arizona, and this is where our assets are today. Another question that came up in our call is, are we ever going to buy assets outside of Arizona? And the short answer is yes. We like other markets also, but we really like what's happening here. So this is where we're focused on now. But
and we look for places where we're familiar. So it's and we know this market really well.
That's just it.
Yeah.
You need to have a deep level of expertise to do well in this business, and it's not something where you just jump into something that you don't understand. And the other co-founder, John, has been here for so long. We have a deep level of expertise here. So we focus on Arizona.
Yes.
So one of the things that's happening in Arizona, some data that's come out, Phoenix was named one of the most popular cities to move in during the first half of 2022. We were number 8 in the survey from Move Buddha. So this is a website that tracks where people move, where they're wanting to move, all these types of analytics, and pulls it together.
Yeah.
So our ratio in Phoenix was 1.19 people moved in for every person who's leaving. So we are well above the 1% threshold. Basically 1.2 people are moving in for everyone that's leaving.
Yeah.
About a 20% increase in population moving in from moving out. And I think that's true. From the people who I know and the groups I associate with, I know there just continue to be people who move in my neighborhood.
And they don't want to leave.
And they don't want to leave. Occasionally you'll get some people who move out. Guy that was supposed to fix my refrigerator, he's moving back to Virginia. He moved here for COVID. And I called him and he said, "Oh, this is my last week. I'm moving back to Virginia. I got my job back or something." So occasionally you'll hear that.
Well, my pool guy wants to go back to Thailand. He came back for COVID and he wants to leave again. I'm begging him to stay.
Yeah, so that movement is normal. But I think overall, and that's what this data comes back to, is there's more people moving in than moving out. We're number 8 on the list of the top 10. So what other cities do you think are in the top 10, Heather?
Where people are moving to?
Yeah.
Well, I know a lot of people are headed to Idaho.
That's true.
Yes.
They are not in the top 10.
They're not in the top 10?
Yes.
Well, and is it Texas? Because a lot of our migration comes from Texas.
So what cities in Texas? Because this is cities.
Well, I like Austin.
Okay, so Austin is 3.
That's where I would go.
There's actually 4. There's 3 cities in Texas in the top 10.
Well, I'm sure it's Dallas and Houston.
Actually, there's 4. Yeah, so Dallas, Austin, San Antonio, and Houston. Charlotte, North Carolina is number 1.
Okay.
Not if you're Christian McCaffrey. He just got traded from the
Is
Carolina
this sports?
Panthers to San Francisco 49ers. So he's migrating from Charlotte to California.
This is a sport.
But the rest of Charlotte, 1.8 people in the survey are moving to Charlotte that are moving out. Then you have Denver. You have Miami, you have Vegas, and you have Atlanta. So if you plot those in the United States, all except for Denver, which is kind of in the Intermountain West, are in what we call the Sun Belt.
Yep.
So you got Vegas and Phoenix in the west, you have Atlanta in the east, in Charlotte in the east, and then you have and Miami. And then you have the 4 cities in Texas. So
people wanted sunshine. They wanted open spaces.
Yeah. So, and there's also some other reasons why people are moving to those areas. A climate certainly has a lot to do with it. But as we think about investing, we continue to see more dollars go to those markets to build multifamily housing, to build housing in general, because more people are moving there. And one of the things that one of the other data points about these Sunbelt markets is in the last 2 years, 70% of the capital flow into multifamily was in the Sunbelt markets. 70%. Mm-hmm. 7 out of $10 were in the Sunbelt. Prior to that, it was still high, 55%. In the prior 20 years was going into the Sunbelt market. So more dollars and capital flowed to those markets. The last 2 years, it jumped to 70%. And part of the reason is they actually are more affordable than Midwest, than the Northeast, than California, the coasts. And they continue to drive and be the place that people want to live, and that means that's where smart dollars are also flowing.
It's just making me a little bit of a narcissist. I realize they're not moving this area for me, but I do feel like I am somewhat responsible.
Well, you're a good example.
There, I did. I left the East Coast to come here, and I was in New York and I loved it. But the pandemic, you really start to look around and be like, what do I want? How much space do I want? Who do I want to be near? Yeah, so I moved back home. Well, not home, my own home, but
where you grew up.
Yeah, a few minutes from my family, and
And so there are some people who, in that situation, might move back to those cities, but overall, the dollars that are invested for housing has continued to stay elevated in the Sunbelt areas. And so that is aligned with our strategy. We're focused on those areas. Arizona's a big part of those. So another good data point in Phoenix, we know that about 100,000 people move to the Phoenix metro area on an annual basis.
Mm-hmm.
I think that's about 8,000 per month.
Yes.
So if you think about that, it's pretty daunting to think, okay, there's 8,000 people every month coming here that need housing, they need services, they need jobs. The Arizona Housing Authority came out with their data, and in the last year, there's been 106,000 new jobs created in Arizona.
We have enormous job growth. The jobs are here. It's going to be hard to find somewhere to live, but the jobs are here.
The jobs are here, and that's kind of the leading indicator. And then once there's a place for people to work and make wages,
Mm-hmm.
they'll find a place to live.
Yeah.
If they're making money,
Yeah.
the economy is going to figure out the housing. And there's a shortage of housing here, but I think there is vacancy. There are places to live. We're not at 99% occupancy. There are places to live, and it's really handling the growth as this continues. So when we think about momentum in a market like Phoenix, and you see that sort of job growth,
And it's a
106,000.
diverse job growth. It is.
Yeah.
We are across the board, whether it's in manufacturing or we're one of the highest kind of opening jobs they're looking for is like skilled labor. It's welders and builders. And so there's a lot of opportunities, whether you're in an office or building an apartment.
And that diverse economy gives it more stability.
Yep.
So if we go back 15 years, Arizona was really focused on construction, real estate. It's kind of this a lot of home flippers, those types of things. A lot of speculative house building. Then we knew with the great financial crisis, we saw how that happened.
Yeah, half-finished ghost towns. Yeah.
And those places are not ghost towns anymore. They're now occupied.
They're full.
But our economy is also much more diverse than it was before. I heard a number today that if you think about where our economy is going, to your point, the skilled labor is there's a big deficit of skilled labor.
Yep.
And one area that I didn't think about, but it makes sense, is with everything that's happening with electric cars, with solar panels on the house, and this transition from fossil fuels to clean energy. Yeah, so one of the things that I saw today is that our economy needs 1 million more electricians over the next 10 years to facilitate all of the transition that our economy is going to make from fossil fuels to green energy, including electric cars, solar panels. That's driving the need for skilled labor to be able to go in and build out the infrastructure that we need to support that. 1 million electricians.
Which is so great for, I think, young people who are starting to look at what do I want to do in the future, that there's just not one path to success, right? Not everyone has to go to college and get a degree. We need someone to do everything, right? There's so many things available. An electrician is a wonderful way to make a living, especially with the way things are headed.
Yeah, and it's a much more healthy economy because we know as a people, we're diverse people. We need people. Some people are more inclined to do that type of work, and they can make really good wages. And that's good to see too. That the blue collar folks can do really well when it comes to wages. That they're not all administrative jobs that are making the high wages. So that's great to see. So I want to shift to what we're seeing specifically with rents and multifamily. This, as an apartment owner, might sound weird, but I'm happy to see that rents have now declined for the past 3 months.
Yes, they're leveled off a little bit. They've come down just a little bit.
Yeah, we started seeing this over the summer, and now we just saw for the third month, rents have declined. So this is the October rent report, which tracked rents, found that rents were down 0.9% from August. So not quite a percent, but it's the third straight month of those declines. This was after rents are up 33% since March of 2020. So that's about 18 months. So rents, soared along with a lot of other things that a lot of other costs of food, costs of cars, rent soared. They've now started to level off. That's happened for 3 straight months. It kind of goes back to what we were talking about before, where the Fed's actions that they started 4 or 5 months ago with raising interest rates, it takes 6 to 18 months to really have that digest into an economy and to slow things down and slow the price of goods. And we're starting to see that level off from rents. So for me, even though I'm an apartment owner, I'm happy to see that. I'm fine to see that because it needed to happen.
Yeah. And I think extremes in any direction make me nervous, right? So anytime you kind of come to the middle is and you hope that people that are where the rents are a little more affordable makes sense, and you have tenants moving in who are able to stay there long term, and they're not having to worry about rent hikes and the market being priced out.
Yeah, and
you're getting a longer, kind of better quality tenant.
Yeah. When you're an investor, you'd rather just have it be steady.
Yeah.
Instead of like big swings. It just feels better if, rents will keep moving up. But when you see these big swings, I'm the same as you. It makes me worry that can people afford this? Thankfully, wages have gone up. Yeah. And so, our economy now with inflation, we've seen everything level up. And now things are starting to level off and plateau. And so this is a positive sign there. So now in Phoenix, on average, a 1-bedroom apartment is $1,227. A 2-bedroom is $1,483. So that is up 29% from a year ago in this survey done by Apartment List. That's still very affordable when you compare it to other large metros, like where you're from, New York. Where I live, New York, 2-bedroom, I was paying $4,600 there. So completely affordable relative to
paid over $2,000 for a studio.
Yes,
which I loved. All about location.
And one other thing that I think can help put this into context is obviously there are different levels of apartments when it comes to luxury apartments, when it comes to more affordable apartments. These numbers are averages across the board, but the way we break that out in the apartment industry is we have Class A apartments, Class B, and then Class C apartments. And what that basically means, Class A tend to be the more luxury apartments. Class C tend to be more workforce housing or more affordable housing. And the other thing that we've seen in the last couple of years was that the Class A and Class B apartments actually saw the highest increase in rents, 14 to 15% increase nationally since March, where workforce housing, Class C, so these are more affordable housing, saw a single-digit 9% increase over that period of time.
Yeah. And I think I was reading that, so the Class A and B, even though they saw kind of the biggest rent increases, also had their wages correspond with that. And so you weren't seeing people missing rent payments. They were kind of continued on as normal. And then you came to Class C, where they had less of a hike, but their wages weren't really moving to correspond with that. But you do have where inflation's affects like groceries and gas, and so that's where you're seeing a little bit of a struggle. So it's good to see rents kind of even out a little bit.
Yeah. And people who had the highest wage increases also had the highest rent increases, which makes sense. And it's kind of just good to see that it's relative. It makes economic sense that the people whose rent would be able to go up and be able to afford it, we're also seeing the higher wage increases. Yes. So apartments are Class A, tend to be the newer buildings, more amenities, nicer finishes. Class B, those buildings might be 20 years old. Yep. 20 years ago, they were the hot building with nice amenities. And then Class C tend to be older buildings, fewer amenities. And oftentimes what we try to do is take something that was like a Class C, maybe a C minus, and take it to a C plus or a B minus. Yeah. And and you can do that as well, and that's where you can see a lot of value as an investor. But the Class A buildings are the most expensive. They have the highest rents. Class B is somewhere in between, and then Class C is for workforce housing.